everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today, and today I'm joined by Paul Robson, who heads our G10 FX strategy team over in London to discuss European currencies. We'll also touch on what's happening here in the U.S., given everything going on with tariffs. So, Paul, thanks very much for joining.
Well, thanks for the invitation. It's been a few weeks since I've come on to the podcast. I'm certainly looking forward to it with everything going on.
Yeah, it has certainly been a interesting couple of days here on both sides of the Atlantic. But I do want to start with the UK because the Bank of England is really fresh in our minds as we record here on Thursday morning here in the US. We did get the Bank of England decision, I should say, this week. What did you see in today's meeting?
Well, I think the first takeaway is that it wasn't, I don't think, as dovish as the market reaction would suggest. That sterling fell against the dollar and the euro on the announcement, and short-end rates rallied to price in additional easing from the Bank of England over the coming year. I don't think either of those two things really reflect more the detail than certainly the result. So the outcome was a 25 basis point cut in bank rate, about 90% expected by futures markets. Nearly everyone on the street in terms of economists thought that they would cut. So that's not, I think, the reason. And I think the main focus was on the vote count, which is so often the case. I know you've said in the past that you're always amazed at how much reaction a simple vote count can move currency markets. And there the vote was 7-2, and that seemed like it was in line with expectations, but it's actually two people on the 9 committee actually voted for a 50 basis point cut. I don't think that was in anyone's base case. We thought we might get a 8-1 or a 7-2, but with two people actually voting for unchanged rates rather than voting for larger cuts. So it felt, certainly knee-jerk, that was a dovish surprise. Maybe the Bank of England was closer to bigger cuts in rates, earlier cuts in rates. But I think the reality is sharply different from that. And it's not until you delve into the detail. So the explicit guidance hints about where the Bank of England might be taking interest rates into the future was unchanged. They wanted to go carefully, cautiously in terms of easing rates. But for me, it was actually the inflation forecast or the overall economic projection. So the Bank of England had raised its expectations for wage growth, obviously a key input into inflation and service sector, which has been sticky. Inflation profile raised because of energy prices moving high. That's not necessarily a surprise. But what was a surprise is that they saw inflation coming down sort of more slowly, and the inflation was higher through the whole sort of the forecast horizon at a time when they both raised the unemployment rate projections and lowered the growth projections. And that just hints that the Bank of England is still grappling with this sort of stagflation, supply side impairment in the economy, just struggling to get inflation out. So I think that those who think it means earlier rate cuts, larger rate cuts to a lower terminal rate, I think ultimately be disappointed. And also those people looking for sterling to go down on that outcome likely to be, in my view at least, disappointed.
So as we sort of internalize that, maybe the overall decision not being as dovish as that initial vote count seemed to suggest, what does this all mean for sterling here and how you're viewing this move lower in sterling, as you mentioned, that we have seen?
Yeah, I think in isolation, there's a couple of other cross currents in sterling, which I think we'll need to go through those in a few moments, I think. But in terms of the Bank of England decision itself, our economist team are keeping to their initial projections for the Bank of England. They still see a couple of more rate cuts from the MPC this year down to 4%. That's a little bit more hawkish than the market. If markets reprice in line with what they're thinking, then that should be supportive. And in terms of the overall projections, we still think sterling dollar will be close to 130 by the end of the year, maybe 126, 127 by the end of the first quarter, although that also incorporates a sort of weaker dollar view eventually at some point, we think, in 2025, and I'm sure that you'll want to touch on that later. And we think that sterling probably outperforms the euro a little bit, not aggressively so, but it's this carry position, this yield advantage, which we don't think has been eroded by today's Bank of England decision. If that changes, facts change, we'll change what we think. But at the moment, we're quite comfortable with that view.
So, Paul, you alluded to this, but relative rates, front end rates, what the Bank of England's saying, what the Fed's saying, that's not the only thing that matters for global currencies, let alone for sterling. What are some of those other current drivers of sterling that you're tracking here, and what are they telling you about the currency's valuation?
Yeah, so I see four current drivers. That's actually more than I normally do. I normally think that interest rates dominate the outlook for sterling in the context of attracting capital to fund the current account deficit. But I think the three others, you've got the fiscal risk premium in the currency that keeps moving around. And I think that that's been a supportive story actually over the last couple of weeks, having seen it as a negative for the currency at the opening months of the year. We've also got a discussion about stagflation risks in the UK. They were sort of inherent in those forecasts that I talked about from the Bank of England. Higher inflation, weaker growth. That's important for the UK on sterling because of the need to attract overseas capital to fund the current account deficit. And the final one is Donald Trump and tariff threats to various countries, and to what extent they do or not fall on the UK in coming weeks, months, quarters, even years. Very quickly, in terms of fiscal risk premium, I think sterling has benefited from this global bond rally that we've seen because it takes the level of yields in the UK further away from a level that might worry people in terms of debt sustainability, wherever that is. I mean, no one knows for sure, of course, level of yields relative to nominal growth. That's all very clear, but that's been supportive, and I think that's been the main driver of sterling doing relatively well. On stagflation, the news remains relatively negative. Actually, in terms, we had some PMIs, softer growth. There's a little bit of chatter in local markets about the government's need to sort of get the economy going again in terms of policy agenda and whether they have the right team in place for that. That's an area to watch. But at the moment, weak growth plays negative. And then the final point of Donald Trump's tariffs. And the way I look at this, and regular listeners will know that I've talked about this a lot before, Hitchhiker's Guide to the Galaxy, Douglas Adams, mostly harmless. And I think sometimes if I'm Donald Trump looking from the White House, maybe the UK gets put into that folder of being mostly harmless. In terms of headline numbers, like the size of the deficit, the parts of the economy that the UK is good at, probably isn't in the crosshairs for the new president. But we've obviously seen it in the last couple of weeks, and I'm really keen to ask you about this in a moment, Brian. But a couple of key takeaways from the early sort of volley of tariffs about sort of concessions, that it's definitely uncertain, and there's always a risk that London markets wake up one morning and there's a new policy agenda that targets certain areas of the UK that might be in the crosshairs of the new administration. So, for example, the NHS, food imports, oil, defence. So we've just got to be mindful of that. And I think where I come down is more volatile in terms of the outlook for sterling. So definitely an area to watch. Well, while we've sort of I've ended on tariffs, maybe we can get you to begin on tariffs. So in terms of this week's news, I mean, the volley of headlines was just relentless. I don't know how you keep up, Brian, but what's your key sort of takeaways, and what do you think? Well, where do we go from here?
Yeah, so it certainly feels like markets are trying to wrestle with these two different ideas with currency markets, right? Because there's specific country and region risks, which, as you mentioned, for the UK feel lesser than others. But then there's just this broader global risk that comes with tariffs and this potential for volatility that you've rightly identified. And we certainly saw that on display this week, where Trump, using his announcement on February 1st to really truncate the timing between the announcement and the implementation date, setting an implementation date for tariffs as Tuesday morning at midnight, leaving only effectively 48 hours for Canada, Mexico, and China to negotiate their way out of the implementation of tariffs. Now, what we have seen since is Canada and Mexico successfully negotiated themselves a 1 month delay in tariff implementation, but China has not. And we have seen tariffs of 10% on all Chinese imports, and also a change in the de minimis exception, which is, maybe less publicized, but also has a very significant implication for consumers who buy products from services that ship direct to consumer from China. So there are significant implications from the tariffs we got. But the way that markets have internalized all of this is once again seeing a president who is focused on over threatening and then backing off in order to, when he gets concessions. And so when we look at the way the markets have responded, we have seen, generally speaking, a weaker dollar on balance. Now, we had a lot of volatility in between there. On Monday, significant dollar strength, particularly against the currencies that were really in the, in Trump's crosshairs here, thinking about Canada, Canadian dollar, Mexican peso. But generally speaking, lower equity markets and weak and strength in the dollar, which I think is a reasonable response here, because flexible exchange rates are really useful tools for adjusting to shocks to the economy, and these would certainly qualify as shocks to the economy for the impacted economies. But in the aftermath, we saw the delays in Canada and Mexico. That's really led to a wave of relief coming over the market here. So much so that even though the tariffs that were implemented against China are very significant, the market has taken this with taken this in stride. Now, there's probably a couple of reasons behind that. Number one, that the Canada-Mexico experience gives the market some confidence that China is going to reach the same fate, that there's going to be some delay coming down the road. That's one piece. A second one is that the market has assessed China's response as meaningfully smaller, less broad, and as a result, less aggressive. The purpose of trying not to encourage additional reciprocal sort of tit for tat tariff escalation that we saw so frequently in the first term trade war in 2018 and 2019. Additionally, the market has not seen China make any deliberate, clear moves to weaken their currency to adjust for the tariffs that have been put in place. And that is also being seen by the market as a reflection of, number one, China's economy being in a very fundamentally different place in this trade war than it was in the first term, but also a sign that China is not actively trying to make the situation any worse. So I think the market is looking at this with effectively a sigh of relief, even though the tariffs that went into effect on China are still quite significant. And so as we look through all of this, we have tariff-related risk premium providing different, significant volatility in tariff-related risk premium as regards the dollar. Strength in one hand, weakness, that we have seen since. We don't think that these risks necessarily go away anytime soon. And if anything, we're looking at the second quarter as a time when the trade push could become a little bit more disciplined as we start to get more economically focused tariffs, things like the universal minimum tariff, which for right now is on the back burner. That kind of stuff comes back into focus for currency markets as we head into the second quarter. So I don't think these tariff risks for global economies are off the table completely, but I think it's certainly right that markets are seeing a president whose trade threats really, his bark is worse than his bite, and are starting to price that way. But that volatility, I think, is going to still be with us, especially as we look ahead. It seems like the EU is one that could be one in focus for President Trump, in the near term. So that's how we're seeing tariffs at the moment, but with an understanding that things can change very, very quickly here.
Yeah, it's certainly interesting. One of my sort of key takeaways was this idea that we might be moving from tariffs threatened on individual, maybe smaller countries. Not to say Canada and Mexico aren't large nations in their own right, but when I think about the UK, UK set out on its own, but this whole tariff focus is going to shift on the big trading blocks. You mentioned China and the European Union, and that's when maybe getting concessions are a little bit harder, whether there's escalation risk, whether people choose not to escalate, give concessions. So it's certainly going to be fascinating. In terms of one of those slightly smaller countries, I think you've sort of touched on it, but Canada is the one, or the Canadian dollar, which had a nice performance this week. Obviously, we've seen the delay in tariffs. What are your thoughts directly on that, but also, just the overall drivers of the Canadian dollar here?
Sure. So just as a bit of context, as part of our framework for the year ahead, one of the things that we have really been focused on is positive on currencies where we feel like central banks are likely to be either constrained in their ability to ease, maybe unlikely to ease because of stronger growth. And certainly, the UK and the US have both been in that basket of central banks where there really isn't as much flexibility to move more aggressively on easing. Canada has been in the other basket because you have seen meaningful progress on inflation. And the Bank of Canada has been cutting aggressively. They have their policy rate now within the band of neutral, and growth there has slowed. Now, in their most recent decision at the end of January, which came before the big tariff escalation and de-escalation we have now seen, the Bank of Canada actually did slow down their easing cycle. They only cut by 25 basis points. And they flagged, which is true, that some of their near-term data have perked up a little bit. Business confidence a touch higher, some of their employment reports a little bit better, maybe seeing some of the early fruit of the policy easing they have done, pushing the policy rate from restrictive territory into neutral territory. And so the way we have been viewing this currency is that there is still room for them to diverge from the US, and that tariffs add potential risks to the top side for this pair. As we stand now, we have seen a significant round trip from all the way from call it 43 up to 148 and now closer to 143. As we sit today, we're at effectively the bottom of the range for the year, and we're almost exactly where we were on the inauguration day on January 20th. And if you remember, on inauguration day, Trump did not escalate on the tariffs as people feared he might, and you saw currencies like Canadian dollar really performed well on those days. So just taking a step back here, our own fair value metrics, which are sort of tariff independent, right? Thinking about things like relative interest rates, key commodity prices, equity markets as barometer of overall risk. Those are not necessarily flagging to us that Canadian dollar is sharply over or undervalued at current levels. In fact, actually going into the tariff announcement, even with dollar Canada at 145, that was roughly in line with where our own fair value metrics had the currency. And so from that perspective, we think that there's, even taking into account these big swings in tariff expectations, we think there's probably a limit into how much further we could see this recovery rally go. Because frankly, we still see an economy that is challenged, it's in a challenging position right now. It's in a different phase of its cycle relative to the US. I think in order to see further downside from here, you'd need to see more material weakness in the dollar, whether that be slowing economic growth or much more clear rebound in Canadian economic data, or maybe just a flat removal of all of these risks from tariffs. And we just don't think we've seen that yet. And so, that's how we're viewing the Canadian dollar here. We think this is still a currency with risks to the downside because of not just all the volatility with tariffs, but because we think that this is an economy where there's still room for them to be easing because the local economy has moderated, inflation has shown that progress.
Yeah, it's a nice way of thinking about it in terms of these currencies falling into baskets, or certainly the central banks falling into different baskets. You mentioned there the Fed, the Bank of England, maybe the sort of RBA, but you've also got those sort of early and aggressive cutters like the Bank of Canada. I guess we do have one other basket, and it includes one central bank all on its own. It's probably feeling a little bit lonely, and that's the Bank of Japan and the yen. So the yen performing pretty well this year, and since we actually published that year ahead that you were referencing. But what do you make of this rally in the yen, and where do you think it goes from here?
Yeah, so the yen is a fascinating one because it has multiple different drivers of its strength, and it feels like almost a reversal of some of the themes, at the end of last year when it felt like the yen couldn't, really didn't have anything going for it. Obviously an important one is the tariff escalation and de-escalation. And frankly, had you told me last week that we would see a meaningful push, sort of de-escalation of tariffs and risk assets would have rebounded, I might have told you that the yen might have weakened in that scenario. If anything, it's actually added to its gains here. And I think a big driver of that is what we've seen in global fixed income markets. We didn't really touch on this too much here, Paul, but you have seen, not just in the US, but also in the UK and the Euro area, you've seen a very meaningful downshift in long-term yields in major economies. And now that hasn't been as large in terms of short-term yield differentials, but I think this has been one of the big bugbears for yen, has been it's very difficult for a low-yielding, negative real yielding currency to find support in an economy, in a global environment where we are shifting into a higher for longer stance, whether that be because of central banks, because of fiscal concerns, what have you. What you have seen is that in the aftermath of a couple positive data prints in the US and the UK, for example, on CPI in the middle of January, you've also seen some change in the expectations around trade risk. You have seen meaningful moves lower in long end yields. Now, we think that some of those moves are maybe more durable than others, but that has been a big driver here of this move, that you have just seen. Relative yields are such an important piece of the puzzle for dollar yen, and you've seen this downdraft, which has come, I think, certainly more aggressive than I had expected, given everything we have seen, all the concerns around fiscal policy that you mentioned, certainly in the UK, but also here in the US. And so that's been a big part of this. But also what you have seen is a Bank of Japan that appears to have maybe a more durable pivot in the hawkish direction. So they delivered a rate hike at their January meeting, but they're also talking a lot more constructively about wage growth. And the data have really backed that up, both at the November and December labor cost index that we have gotten from Japan. You've seen meaningful upside surprises to delivered wage growth, both on the sort of headline and also in the underlying factors that we know the Bank of Japan very closely tracks. All of this is to say that the Bank of Japan has been looking forward to Shunto wage rounds. This is the time of year when big labor unions are all negotiating new contracts. This is a massive point of emphasis for the Bank of Japan in terms of the sustainability of higher inflation in Japan. And the data they have gotten and the anecdotal evidence they have seen have given them a bit more confidence in achieving the underlying inflation scenario and achieving more sustainable wage growth. And so the Bank of Japan has turned a little bit more, maybe a bit more constructive here in terms of its overall outlook. Now, does that mean that the Bank of Japan is about to be hiking much more consistently, much faster? We're not so sure yet. We still think that this is a currency that's going to have negative real yields, for the time being, and also that on a relative basis, we're still looking at a Bank of Japan cycle and a Fed cycle that end at vastly different levels. So what that means is this currency is still going to suffer in absolute terms. It's going to be a very carry punitive currency to own. And so what that means is, I think it's going to be difficult for yen to sustain these level of gains. If anything, it feels like the positioning and the downdraft in long end rates has been a real driver of this. That's not to say that there haven't been local developments that have really been moving this. But I think sustaining these moves lower in yields is likely going to be key to allowing this to continue. A last wrinkle here worth considering is whether or not the change in the way that markets are thinking about tariffs and the fact that the China tariffs went into effect here in the US, potential downside risk to China if those are to remain in place. Now, of course, the near-term reaction in markets has been that we're going to get a resolution. You see that across currencies. But I can't help but look at the moves we've seen in US Treasuries and see lower long end yields and wonder if some sort of perception of hard landing risk is maybe sort of finding its way back into currency markets, where as recently as a month ago, the whole world was thinking we're in a no landing scenario. US is just off to the races. Fed's never going to be, or Fed's effectively an indefinite pause. I almost wonder here if some creeping suspicion of, okay, tariffs are going to have maybe a bigger downdraft in terms of growth, that there's real growth risks that do come with this. And maybe some of that is finding its way into pricing as well. And that feels like it's of course important for the yen. But, we're going to have to look ahead to the US data. It feels like the CPI coming up next week, a really big one. We're expecting we're expecting a bit of a bounce back here in the CPI at 0.3%. So, does that mean that the yen rally that we've seen faces a bit of a headwind in the near term? We think so. But we're watching very closely these developments in long end yields because we think that's been such an important driver, both to the top side into the end of last year and more recently to the downside as we've seen yields move lower. So, Paul, I think that's all we have time for. We've covered a lot today. So I want to thank you for joining and for giving your insights on global currencies. And also to our listeners, thanks very much for listening. As always, please click subscribe to subscribe to our channel and also like the podcast if you enjoyed this kind of content. Thank you very much.